Hi, I'm Mike Allers, and today I want to talk to you about the history of money. More specifically, the supply of money in the United States and how that relates to our country's history. So what you'll see here is I've drawn a chart, and I want to start drawing in some dates for you, and you'll see why that's important. The first date is 1913. 1913 was the date that the Federal Reserve was, the year that the Federal Reserve was created. And in 1913, this black line is going to represent the supply of money in America. And the green line is going to represent the value of gold as it relates to the value of money. So you'll see the first thing is in 1913, the value of the dollar was higher than gold. Gold was below. And then a crucial date happened. This is 1933. Money, the US dollar, was taken away from the gold standard. When that happened, the free market actually bid up the value of gold to match the dollar. And at that point in time, the value of the dollar as it relates to an ounce of gold was about 1/20th, and it went from 1/20th to 1/32. So it looked like the dollar, like gold actually rose. It didn't. The value of the dollar actually dropped based on what the free market did. Now, after that point in time, after the dollar was unpegged from gold, you can see gold kind of drifts down a little bit. Then we have a crucial date right here. This date is 1971. And in 1971, Richard Nixon was our president. And what he did at that point in time is he unpegged dollar from the gold standard again. And when that happened, you'll start notice this line is starting to creep up. We're beginning to print money more and more and more. And I'll say here that when we print more money, what happens is the value of the dollar starts going down. We don't necessarily see it right here, but we'll see it as we move further in history. So we see this, and then all of a sudden we see gold shooting up, and this date is 1980. In 1980, gold actually went up above the value of the dollar for about a year and then came back down. What's crucial to note about that is that at that point in time, we could have taken gold and went back to the gold standard. And the reason why we use gold and the dollar is this is the amount of gold it would take to buy back all the US dollars. And we could have done that right in 1980, where the value of gold was about $800 an ounce, okay? So now as we move forward, you're beginning to see more and more money come into the supply in the United States. That's what's going on here. And when we get way over here in 2008 out to 2009, gold actually went up to $950 an ounce. This is a very crucial period in time here because what happened was in the first 200 years of our country, this was the amount of money that was in supply at that point in time, $825 billion from the first 200 years. Then in 2008, in September of 2008, we had Freddie Mae and Fannie Mae bailout. When that happened, the government printed an additional $900 billion and put it into the U.S. money supply in 2008. Look what's happening to the money supply curve. It's going up. And then in 2009, in March of 2009, we had the bank bailout, and that was $1.2 trillion. If you're not catching this, this is critical. We went from $825 up to $3 trillion in our money supply. That is about a 3.7 multiplier. In other words, our money supply grew by 370% in 1 year. Now let me explain why having all that money and printing more money, the government printing more money, hurts our economy. It basically devalues our dollar. It's like anything else. If you have a cell phone, an iPhone is pretty much the hot craze right now. If there was 2 iPhones in the world right now, they'd be very expensive, right? Well, because there's more and more and more iPhones, they become less expensive to buy. Same thing with money. The more money there is, the lower the value of our dollar. So a lot of people haven't really felt that, but if you go to the grocery store, the gas pump, or you're dealing with any kind of health care, you'll know that it's becoming more and more expensive. Now let me show you something else here. So in by '09, the value of gold was up to $950 an ounce. Let's fast forward this now. 2012, gold is roughly $1,600 an ounce. Wow. See, what happens is when you print more money and you have a currency that's not tied to a gold standard, eventually gold will catch up and match where it needs to be. But what's happening is gold isn't really going up. The value of the dollar is coming down. So as you see gold going up, it's just getting to the place where gold and the dollar match where it should be. Here's what's really important. If gold was where it should be based on our monetary supply right now, gold right now would be up here and it would be at $15,000 an ounce. So, again, it's not that gold should be rising, that's what's really going on with the value of our dollar. So why is this video important? Why is what we talked about important? There's several things. The main reason is to know that I believe that there's going to be a time when hyperinflation starts creeping in, and we're going to see gold and precious metals, things like gold and silver, really taking off. You as an advisor or you as a client want to have this in your portfolio just to offset anything else you have, because probably all the investments you have are tied to the dollar. And if they're tied to the dollar, we're moving into a point in time where the dollar is becoming worth less and less, which means your purchasing power is going down significantly. Gold hedges against that and it covers you for that. Now, a couple other things that are important to note. Since 1971, when we went off of the gold standard for the second time, let's look at what happened. We've always had bailouts, and in the 80s, bailouts were in the millions. In the 90s, bailouts were in the billions, but look in the 2000s, bailouts are in the trillions. So I challenge you to think about what's going on in the world today. Is there any validity, is there any truth to what I'm saying once you really step back and take a look at what's going on? So what we have here is a brief history of our dollar as it applies to being tied to gold, and you can see that gold tracks it and it offsets the devaluing of the dollar. And to bring home kind of as a bottom line to all this, our dollar is what's called a fiat currency. And fiat means let it be so, which means somebody has a sheet of paper, they put your face on it and says, hey, that's worth $100. And there's a saying is this, is every currency ultimately goes to its inherent value, which is zero. I'm Mike Allers. I hope you enjoyed the presentation. Look forward to speaking to you.